Hey everyone! Welcome back to Wealth for You, the channel where we make money matters simple and personal. And today we're diving into something huge. Markets are going wild. President Trump just announced a 90-day pause on tariffs. Stocks soared overnight. But bond markets? Still jittery. And fear is spreading fast. So the big question on everyone's mind is, what should I do now with my money? Whether you're investing for your future, preparing for retirement, or just trying not to mess up your financial goals. This video is your calm in the storm. I'll show you how to protect your wealth, avoid emotional mistakes, and stay smart in uncertain times, especially if you're investing from Singapore. So don't forget to hit that like button, subscribe to Wealth for You, and stick around till the end, because the worst mistake you can make now is acting out of fear. Let's make sure you don't. Now, before you panic buy or panic sell, pause. This video is your step-by-step guide to staying calm, staying smart, and protecting your money, no matter what's happening in the headlines. Whether you're already investing, just getting started, or close to retirement, this one's for you. Let's break it down. Part 1. What's happening? So, what's all this noise about tariffs? President Trump just announced a 90-day pause on tariffs for over 75 countries, everyone except China. Markets shot up overnight. The Dow jumped 8%, Nasdaq soared 12%, the biggest one-day gain since the 2008 financial crisis. But wait, it didn't last. The very next day, markets pulled back again. Why? Because the bond market wasn't buying the optimism. Yields spiked, signaling deeper fears about inflation, slowing global growth, and even the risk of a recession. So while stock investors were cheering, the bond market was sending a warning. This is just a pause, not peace. The uncertainty is far from over. What does that mean for us in Singapore? Let's talk about that next. Part 2. For existing investors. Let's start with you, the long-term investor already in the market. Stay invested. Don't panic. This is not the time to sell everything and run for the hills. If you're diversified, meaning you own a mix of global stocks, bonds, and not just Singapore banks, stay the course. Markets go up and down. That's normal. But the biggest gains usually come after the biggest fears. In fact, just yesterday the market had one of those best days. Miss that, and you miss a big chunk of growth. If you're really feeling anxious, it's okay to move a small part, say 10 or 20%, into something safer. Not because the math says so, but because your peace of mind matters too. Part 3. For new or young investors. Now, if you're just starting out, maybe you're in your 20s or 30s, the most important thing is start with yourself, not the market. Ask, do I have a stable job? Do I have at least 6 to 9 months of emergency cash saved up? If yes, then you can start investing slowly. Don't dump all your money in at once. Use a strategy called dollar cost averaging. Invest a fixed amount every month, no matter what the market is doing. That way, you don't need to time the market. You just ride the wave. And please, don't touch those investment-linked policies that penalize you if you miss a payment. In uncertain times, cash flexibility is gold. Part 4. For retirees and near retirees. To our uncles, aunties, and retirees watching, this part is for you. When you're drawing down from your investment portfolio, volatility hits harder. Why? Because if markets drop and you're withdrawing money at the same time, your portfolio might not recover. So what can you do? Take out 1 to 2 years of expenses now and park it in something safe, like cash or Singapore savings bonds. Use CPF Life as your steady, reliable income floor. It pays for life, it doesn't fluctuate, and gives you up to 6% interest. If you're 5 years from retirement, consider locking in your portfolio value now, a strategy called immunization. Bottom line? Protect your downside and don't rely only on market-linked investments for daily needs. Part 5. Why staying calm matters. I get it. The news is loud. Headlines are dramatic. One day its markets are booming. The next day its recession is coming. But here's the truth. Making big money decisions based on fear or hype? That's how people sabotage their future. Panic selling in a downturn. FOMO buying after a rally. These are emotional reactions, not smart strategies. Wealth isn't built on headlines, it's built on habits. Consistent saving, smart diversification, and staying invested over time. That's what really grows your wealth. In investing, it's not just about what you know. It's about how well you can stay calm when everyone else is losing their heads. Because if your emotions take over, even the best plan won't save you. So when the market swings, pause, breathe, and remember your long-term goals. That mindset is what separates successful investors from stressed-out ones. Part 6. Final tips and wrap-up. So here's your calm investor checklist. Already investing? Stay in. Stay diversified. Just starting? Build your cash buffer. Invest slowly, monthly. Retired or close to it. Protect your income. Use CPF Life. Withdraw wisely. Everyone, tighten your spending. Review your goals. Don't chase the news. Remember, the enemy isn't the market. It's fear and greed. So stay cool, stay smart. And as always, know yourself. Focus on your goals, and you'll win the long game. If you found this helpful, give this video a like, and share it with someone who needs a little calm right now. And if you want more real talk on money and investing, subscribe to Wealth for You. We've got your back. Till next time, stay safe, stay steady, and keep building your future.